Welcome to another episode of Mike Reads. Today we'll be continuing in our series in Henry Hazlitt's Economics in One Lesson with Chapter 5, which is entitled Taxes Discourage Production. As I've mentioned in previous reads, we are doing this as a parallel read with Thomas Sowell's Economic Facts and Fallacies, so I'll put a link to that series in this video's description. As I've also mentioned, we'll be doing at the end of by request, of course. At the end of each chapter read, we'll be doing an analysis and review. So I'll put in the description of this video timestamps so that if you want to just jump to the analysis and review, you can do that. So without further ado, let's jump into what is going to be a very short read nicely. So hopefully there'll be a short analysis after that, which is Chapter 5, Taxes Discourage Production. There is a still further factor which makes it improbable that the wealth created by government spending will fully compensate for the wealth destroyed by the taxes imposed to pay for that spending. It is not a simple question, as so often supposed, of taking something out of the nation's right-hand pocket to put into its left-hand pocket. The government spenders tell us, for example, that if the national income is $1,500 billion, then federal taxes of $360 billion a year would mean that only 24% of the national income is being transferred from private purposes to public purposes. This is to talk as if the country were the same sort of unit of pooled resources as a huge corporation, and as if all that were involved were a mere bookkeeping transaction. The government spenders forget that they are taking the money from A in order to pay it to B. Or rather, they know this very well, but while they dilate upon all the benefits of the process to B, and all the wonderful things he will have, which he would not have had if the money had not been transferred to him, they forget the effects of the transaction on A. B is seen, A is forgotten. In our modern world, there is never the same percentage of income tax levied on everybody. The great burden of income taxes is imposed on a minor percentage of the nation's income, and these income taxes have to be supplemented by taxes of other kinds. These taxes inevitably affect the actions and incentives of those from whom they are taken. When a corporation loses 100 cents of every dollar it loses and is permitted to keep only 52 cents of every dollar it gains, and when it cannot adequately offset its years of losses against its years of gains, its policies are affected. It does not expand its operations, or it expands only those attended with a minimum of risk. People who recognize this situation are deterred from starting new enterprises. Thus, old employers do not give more employment, or not as much more as they might have, and others decide not to become employers at all. Improved machinery and better equipped factories come into existence much more slowly than they otherwise would. The result in the long run is that consumers are prevented from getting better and cheaper products to the extent that they otherwise would, and that real wages are held down compared with what they might have been. There's a similar effect when personal incomes are taxed 50, 60, or 70%. People begin to ask themselves why they should work 6, 8, or 9 months of the entire year for the government and only 6, 4, or 3 months for themselves and their families. If they lose the whole dollar when they lose, but can keep only a fraction of it when they win, they decide that it is foolish to take risks with their capital. In addition, the capital available for risk-taking itself shrinks enormously. It is being taxed away before it can be accumulated. In brief, capital to provide new private jobs is first prevented from coming into existence, and the part that does come into existence is then discouraged from starting new enterprises. The government spenders create the very problem of unemployment that they profess to solve. A certain amount of taxes is of course indispensable to carry on essential government functions. Reasonable taxes for this purpose need not hurt production much. The kind of government services then supplied in return, which among other things safeguard production itself, more than compensate for this. But the larger the percentage of the national income taken by taxes, the greater the deterrent to private production and employment. When the total tax burden grows beyond a bearable size, the problem of devising taxes that will not discourage and disrupt production becomes insoluble. All right, that concludes tonight's read, and we will move on now to the analysis and review section of the video. All right, welcome to the analysis and review side of this video. So the read was actually very short, so I'm going to try to keep this analysis and review kind of short. There's really not much to get away from this chapter. He talks really about the title of the chapter is Taxes Discourage Production. And I think that is basically the only takeaway to get from this chapter if we're really focusing on things. We could nitpick his assessment of the percentage of taxes that are taken from people through income, because in his time, in the 1940s, very few people actually paid income tax, and it was paid almost entirely by the wealthiest people and the wealthiest of businesses. So it was the income tax structure was very, very, very different when he wrote this book over 70 years ago than it is today. But the points that he's making are points that we've kind of already gone over, so it shouldn't take long to go through all of this. The first point that he's making is that whenever you tax somebody, remember that you're robbing Peter to pay Paul, as Thomas Sowell likes to point out, and I'm sure he either has already mentioned in our reads in Economic Facts and Fallacies, or he will eventually make in that read. He does a lot of that in his what most people consider his magnum opus, which is Basic Economics, which he's written as basically a textbook to that. I'll link to my review of Basic Economics in this video's description as well, because I've actually already read that and reviewed that as well. The point is that what's missed when you give money to a certain cause from the government, everybody likes to say, look at how these people are living because we gave them money, and forgets the other side of that picture, which is that you had to tax somebody. You had to take money away from something to give it to somebody else. In this case, what you're talking about in terms of the broken window fallacy, what gets missed is the opportunity cost. And there is an opportunity cost to robbing Peter to pay Paul. And this harkens back to Smith's fundamental lesson, which is that when you have a mutually consensual transaction, obviously and inherently it will benefit everyone. However, when you have governmental interventions, that isn't a mutually consensual transaction necessarily. There's some ways where it may be conceived of as one. If you have like an island, for example, and there's only 3 people on the island and they unanimously decide to allow the third person, who is government in this case, to do something. Yeah, I mean, that's a bit different when you have something like a unanimous consent. So in this case, obviously, if you are using that money to do the thing that it's not otherwise going to have done, there is a material net loss for society because of that of Smith's lesson, what Smith taught us, that we're no longer engaging in a situation where the people that might be involved in this transaction are engaging with mutual consent. I talked a lot about this and expanded in great depth on this lesson in my series on interference, which again I'll link to in this video's description. I've talked about it a lot less. So that was the first lesson, is that whenever you're paying taxes, remember that you're basically robbing Peter to pay Paul. Clearly, there is some element of productivity that must be at net lost, because in this case, you're removing an element of consent from the transaction. Clearly, it would be more productive to have allowed that person to have done the thing that they would have done. And maybe that would have been to provide employment for that person. Let's say the tax dollars is going to a person, to provide employment to that person, who in return not only gets that money, but creates some level of productivity for that company or for that person that's hiring them, that's paying them in the first place. And we've talked about this in other reads, where by creating that extra bit of wealth, then you create the opportunity for more income to come in for that individual, or for the creation of more jobs to perhaps help somebody else out. So that's the first lesson to get from this chapter. And the second lesson is that the resulting windfalls are less from your successes when you involve yourself in risk. Let's think about it this way. If you have the Powerball, there's an enormous lot of risk involved with the Powerball. You could lose everything. Now, each ticket's only going to be $2 nowadays, but you have the potential to lose everything. And the odds of you losing everything are incredibly high. So there's an enormous amount of risk, which means that you're not willing to endeavor into that enormous lot of risk unless there's an enormous lot of return on the other end. So imagine what you would experience if you, for example, had the Powerball jackpot only be $50. Well, if there's a 1 in a zillion chance of you winning that $50, there's plenty of other lotteries to play where the prize of $50 is significantly more likely to manifest. You're much more likely to win that $50 prize. These are less risky ventures because you are less likely to lose everything and more likely to win at least that $50. So in that case, what winds up happening is you get fewer people who are engaging in risk when it comes to business. And yes, when you increase the level of risk you're willing to incur, then what you wind up doing is you wind up having certain people, certain businesses lose a lot more. So your losses are a lot more, but also so are the windfalls. So are the advancements. And what winds up happening is in the nature of things and Smith talks about this at quite a great length in The Wealth of Nations, and I'll have a link to that read as well, so you guys can check that out, about how the natural tendency is for those risks to eventually, those risk-taking ventures, to eventually turn that curve upward and result in greater income. And the reason that's obviously the case is Smith's fundamental lesson, that people would not willingly engage in these risks if there wasn't a real chance of actual success on the other end. And society as a whole would necessarily just inherently have a built-in discouragement to that risk-taking if the net effect isn't as steep, if the number of times that you win is significantly more than, or the winnings from when you win exceed the losses from when you lose. So that's why in a very free market society, when it comes to things like the stock market, you see it do this a lot more, and the dips are a lot bigger, but they're not very long. So what winds up happening is those dips are pretty steep down, but the ups are absolute skyrockets, and the net is that you wind up tilting that graph upward. Yes, I'm doing this for your viewing. I'm doing this backwards for me so that you guys can see how that curve works. And the incurrence of risk is what in the end creates jobs, builds wealth, and leads to greater innovation. You don't have somebody saying, listen, I want to try to invent this thing, I want to try to resolve this problem, unless there's a giant incentive on the other end. Now, there are people who are incredibly, like Elon Musk, are incredibly wealthy and are incredibly charitable and would do something just for the pleasure of having invented the thing. These are incredibly few people, and this does not long-term account for the overwhelming majority of encouragements for wealth. I'm not a very wealthy person. The only reason I would cash in everything I have, basically, to invent something would be if there was a giant windfall on the other end. So Hazlitt, I think, actually goes into much more detail on that later. I think so does actually Sowell in the later reads on how these sort of things create how risk-taking tends to, a lesser aversion to risk tends to result in the creation of jobs, the building of wealth, and the necessary effect of greater innovation. I talk about it in great detail. I forget which I think it was part 3. I can't remember which part of my talk on interference, but I did talk about that in great detail in that series, so please do check that out. I'll link to that in this video's description. Now, this chapter isn't trying to say that taxes are necessarily a bad thing. It isn't a refutation of the need for certain necessary taxes, and this is made explicitly clear on page 38. A certain amount of taxes is, of course, indispensable to carry on essential government functions. Reasonable taxes for this purpose need not hurt production much, which is because these are the sort of things that, like he says, are going to protect that production in the first place. The kind of government services then supplied in return, which among other things safeguard production itself, more than compensate for this. So this is why I've said many times that a free market economy isn't just anarchy. A free market is one that is free from interference with mutually consensual transactions. That interference doesn't have to come from government. It can come from what we consider today criminality, in which case that necessitates a very minimal degree of governmental intervention. And if the governmental interference with mutual consent tends to be less at net than the interference it is looking to eliminate, then obviously, number one, you actually, in the long run, wind up creating an actual consensual transaction here, because everybody is obviously inherently consenting to that. But also you reduce the amount of interference. So government in that case has met the heuristic guideline that suggests that at net we are looking to reduce that interference. Again, I went into great length on this on my series on interference. That's the place to check that out. The point of what he's making with this chapter is just a simple reminder that tax rates should basically set toward the minimum necessary. So when we look at taxes and we look at collections, we're looking to establish a government that does the absolute minimum necessary, just these very few minimal things. It doesn't spell out what they are, but you can conceptualize it that robbing Peter to pay Paul is probably not something he's in favor of. So in the case of something like a military, obviously he would probably be in favor of that, because the military protects these productive facilities from from invading marauders, let's say. So that's all there really is to go over with that. Robbing Peter to pay Paul, and remembering that the resulting windfalls are less, with less literal incentive to incur risk. So we will continue on with this series, with chapter 6. Next week, we will be actually continuing on, as we always do, because I like to alternate these reads with some Thomas Sowell, Economic Facts and Fallacies. So until then, this has been Mike, signing off.